evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for September 17th, 2019. Will they or won't they? That's the big question on everybody's mind, at least with respect to the Federal Reserve. They are announcing an interest rate policy change or no change on Wednesday afternoon. That's going to be September 18th. So the video tonight will talk about the probabilities of the rate cut, what that might mean, and how we might put on trades, manage trades, or protect ourselves. But first, as Don often shows us, we have a CBOE probability, or CME group, probability grid. This is a target rate, a website, a CME group, etc., of the rate cut for tomorrow. And if you look closely, this is for probabilities of keeping the rate the same at the target rate. Right now it's 2%. That really means 2%, or 200 basis points to be accurate, but it's really 2%, 2 to 2.5%. Or if they lower it to the target rate of 1.75 to 2.0. And what's the odds and probability on that? Right in the middle. So that is right about as even as you can get them. So essentially, we don't know, the market don't know, and I'm not even sure the Fed knows. But as traders, we can't just throw our hands in the air and walk away. We have to put positions on, manage open positions, or roll positions as needed. So we will be carefully watching the Federal Reserve, what they say, and what they do with interest rates. Personally, I don't think they're going to cut rates, but I am only one voice, and that voice doesn't really matter when the Fed funds rate futures or the probabilities, target rate probabilities via the CME Group website is 50-50. So the S&P, we'll just do a quick update, is into 3,000. This is our hourly charts of the quad market grid. That's gold and bonds, the 10-year note. We have crude oil, which did its volatile bounce on the Saudi Arabia oil fields, but maybe headed down because the most recent headline on that area was that they have returned production to normal. We'll certainly see if that plays out, but nonetheless, that's our spike, the trend day on Monday, and the pullback on Tuesday. These are overnight session grids to keep with the continual contracts. So the S&P maintains this uptrend, higher high, higher low, higher high, higher low, higher high, higher low. I've drawn a connecting trend line, and again, the key focal point will be 3,000. So if you are an intraday trader, frame your trades and trade the departure, which means bullish if a departure takes place to the upside or a bounce or a trend continues. And I think that might happen if they do decide to cut rates. The cut rate scenario is the bullish equity market scenario. But of course, if we falter, fail, and break under 3,000, that opens up to a sell swing toward 29.50 or even lower than that. And of course, that would be maybe if they don't cut rates, you might see the market fall. Crude oil is on its own pathway because of outside forces, geopolitical risk, even though it tends to correlate well or positively with the equity market. So higher highs, higher lows in crude, higher highs, higher lows in stocks, but crude has been more in a trading range with a bullish buy. Ironically, we had a bullish buy opportunity off of 54.50 per barrel. And of course, that's a surprise weekend outcome. And nonetheless, a departure from 62. Over on the other side of the equation, we have gold into 1,500. And if we talk about will they or won't they, the rate cut, if they cut rates, think of that as the Fed saying we are creating inflation. And that could be quite bullish for gold, which already has a bullish potential buy or support play off of 1,500. We'll look at these on the daily charts in a moment. The key market to watch will be bonds. This is the price of the 10-year Treasury bond with ZN. You had the break under the 130 level, but that's going to be a bounce play. This looks better on the daily chart, so we'll look at that just in a moment here. If you see it the other perspective from the yield, what you'll see there is the 10-year yield, the Treasury yield at least, has pushed down from 1.9%. What is 1.9%? Roughly 2%, if you will. It's the current Fed funds rate, which is about 200 basis points, or roughly 2%. I find that interesting. Now, let's take a look at the daily charts of all of these and discuss probabilities of a cut. Unfortunately, it is a coin flip, and so we do not know exactly what they're going to do. So any surprise probably results in a volatile Wednesday into Thursday, maybe even Friday. So that's an upside break, just planning out the future probabilities. If we see the index market or the S&P above the 30 level or higher, especially on high volume on a rate cut outcome or any other bullish news about China potentially, then you could see the equity market extend even higher, similar to this June into July period where we also had new all-time highs. And that resulted in the next few weeks of being almost straight up action. Not looking for a whole lot of upside move, but still the dominant thesis or the bullish breakout thesis continues on new highs. If the Fed decides not to cut rates, well, we do have resistance into about 30.25 and of course negative divergences. So that continues to be our departure pivot. It's not officially 3,000, but it is 3,025 or 3,030. So we were on a couple day pullback scenario, and if the Fed does not cut rates, you might see this trend line break and the market trade back toward the volatility box, which is roughly 29.35, 29.50, or into this spot. The same will be true for the Dow mini futures. It's playing with the 27,000 level, and the Nasdaq just shy of 8,000, which is right now at about 7,900. A critical pivot for the Nasdaq is just the simple level of 8,000. The Russell remains the odd market out. I'll update this now, that it trades into 1,600. So 1,450 and 1,600 remains the Russell's upper resistance and lower support. In crude oil futures, we had the break. I'll again update the chart there. Trading range, low to high, 50 per barrel, midpoint 54.50, and upper point just above 60. Crude bounced into this news-fueled zone and now appears to be coming back down into this trading range. We'll update that as well, which is about 57.50 per barrel. So the main idea is that crude, unlike the equity market, which is in a strong uptrend, trades sideways. It looks a little bit like the Russell to an extent. If we compare sideways, 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 and then similar, not perfect, of course, for crude oil. Now, gold is the market to watch. And if the Fed does cut interest rates, cutting rates should be seen as inflationary. So the cut rate cycle, or the lowering of rates or stabilization of rates and other factors, economic uncertainty, etc., has given a bullish boost in gold prices. So right now they're into 1,500 per ounce, and that will be the critical pivot going into this week and to next. If they cut rates, odds favor a bounce off of 1,500. If they do not, you can see the premium or the money or the proceeds come out of gold. And that can lead to a sell swing, especially if under 1480 all the way to 1450. So for intraday and short-term traders, gold has an open zone to the downside, especially if rates are held the same, but it also has a bullish bounce play off of 1,500. Think of that in some ways similar to 3,000 in the S&P. Now we'll finish up with bonds. We'll talk the 30-year bond first, and that is roughly 157 is your pivot point. It looks a little bit better on the weekly chart because it is playing off of the 20-week exponential. Notice how strong, quickly, and violently the bond market has rallied from the later part of 2018. And that is remarkable. So it's totally expected to see a pullback, but this week could lead to a bounce scenario. The same is true in the 10-year Treasury note. And we can look at that on the daily chart. Similar picture. It is into about 128 on the index level. So that is a pullback. There were divergences, overextended, retracement, overextended, retracement, just like these other times. This would be the fourth time since that rally reversal low. and that was about 118, 117 on the index. And higher highs, higher lows, all that led to the most recent pullback. So we are looking for a continued bullish potential bounce to the upside in bonds. It is easier to think about this as a yield perspective. So TNX is your treasury yield. So the 10-year note, the treasury yield on it has been going down as the Fed has cut or did cut rates, kept the rates the same, and then cut them recently. So that led to a continued downtrend from about the 3.2% area. That's what that 32 means, is 3.2%, all the way to 1.4. As mentioned in prior videos from Don and myself, this 2.0 level, or the 2% level, is your critical reference point. It's the pivot. So as the 10-year note rallied up into it, we are seeing this pullback, technically in bond prices, but a rally against a downtrend in yields. So if they cut interest rates, we would think to see the treasury yield go down. So this is a cut scenario to the downside. If they do not cut rates, meaning they keep interest rates the same, you might see the 10-year note push back toward 2%, which, once again, brings us to where we are on the overnight Fed funds rate. And that's going to be just the opposite in bond prices. So for ZN, a rate cut scenario could lead to lower bond prices, and a rate stability, keeping rates the same, that's going to let the yields go down, but bond prices go up. It may sound confusing. We'll end the video just discussing the broad perspective of intermarket. Think of rate cut as similar to saying we, the Fed, will create inflation. By creating inflation, that leads to potentially higher equity prices, higher crude oil prices, and higher gold prices. At the same time, leading to possibly higher bouncing in bond prices. Now, if they decide not to cut rates, I know 50-50 outcome. That could lead to maybe a possible sell-off in the equity market, additional downside movement to 54.50 in crude, maybe a break under 1,500 in gold, and maybe additional downside action. Now, we don't know because the bond market could be a little different, especially if equities come out. That's their kind of the mystery market. If money flows out of equities, does it flow into bonds? If so, that's bullish for bonds. And if the Fed cuts interest rates, that's also bullish for bonds. But we'll have to counteract those forces there. We'll certainly see tomorrow. But as always, be careful and be safe. This is Corey Rosenblum with your Theo Nightly video for September 17th, 2019.